Hey guys, so the S&P 500 hasn't done anything since the start of 2021. And if you remember what happened at the start of 2021, that's when all the supply chains shut down and everything was bad and there was a recession coming and um all the world was ending and all of this stupid stuff Wall Street said. And we're at those levels right now, which doesn't make any sense, but we're there. So, and this is why we're there. The 10-year yield has been going up for 3 years straight, and it's almost at that 5% level that investors think is really important, I guess. We just went over $1 trillion in credit card debt, which is crazy. Real wages shot up in 2020, and they've just been down since then. I really don't think we've kind of realized that they've been going up since then because um it's just been so recent that I don't think it's enough time for people to realize. Mortgage rates are almost at 8%, which is crazy. And the last time we saw that was in like 2002 or 2003 or something. So that's crazy. And the savings rate is just below 5%, which isn't very good compared to the spike up in COVID, where people couldn't really spend their money, so they were kind of forced to save. The fear and greed index is just on the edge of extreme fear. I think it was actually in extreme fear on Friday for a little bit, but apparently it bounced back. And consumer sentiment is very low. We haven't seen this since like 2010 maybe. And most importantly, Fed funds or Fed lags are probably gonna catch up to us soon. Because it usually takes 1 to 3 years since they start raising to for the Fed lags to catch up. So they started raising in the start of 2022. So 2 years is the midpoint of that, and so it might catch up in the start of 2024, or it might be catching up now, and that's why the stock market is down so much. Maybe I don't know. But the positive is that GDP is still growing, and it grew more than analysts expected, which means that the basically the United States economy is still growing, and that's good, and that's not recessionary. Um, the this is my favorite chart to look at because large cap and small cap and mid cap are the large caps are at all-time highs, and the mid caps and small caps are at all-time lows. So that's really interesting to me because that means that there's deals in small caps and mid caps and even some large caps. And I can take advantage of those deals and I can make some money. So, yeah, that's real exciting. Um, what's also bullish is that you got MasterCard and Visa beating, you got the big banks beating, Goldman Sachs and Morgan Stanley. You got all big tech beating, Amazon, Google, Microsoft, and Meta. And you got the GOAT Chipotle beating, which is really important for the stock market. I'll show you why in a little bit. Um, rates aren't going down anytime soon because the Fed has been hawkish for like a long time. So, yeah. And inflation's still not at their 2% goal. And they've been very clear that they're not going to lower rates until inflation is at their 2% goal. And the consumer is still spending. That's why Chipotle is the GOAT, because them beating shows that the consumer is still spending. They're spending on debt. That's why the big banks are beating, because the big banks make money on debt. So, yeah. We're most likely coming out of the earnings recession, if there ever was one, because everyone's beating, and that usually means that the economy is booming. And if the CEOs of these companies knew we were in an earnings recession, they would probably sound a lot not as optimistic about the market on their conference calls. And they seem very optimistic, so yeah. And there's a possibility of a soft landing. Once again, because of the CEOs sounding optimistic and because the data points just show that there isn't a very big chance of a soft landing because the economy has held up since through these times of the yields going up and um real wages coming down, and now they're starting to go up. So it's only going to get better from here, I think. I'm really excited for earnings next week because you got a lot of big companies. I circled the ones I think are gonna beat in in green and the one I think are gonna miss in red. And I circled AMD in blue because I really don't know what they're gonna do. But I'll be paying attention to all these companies, mostly PayPal and Starbucks, because I really like them for the long term. And I actually own PayPal. I might start a position in Starbucks. It's looking pretty attractive right now. So I don't know. I'll keep you guys updated on that. Um, but let's go to the stock market this week. So it's been pretty much down this week, and that's just because the yields are so high. They're at like 4.9%. That's where they ended the week. They're actually above 5% for like 2 hours on Monday, which is kind of crazy. And so, yeah, that's the main reason why the stock market is down this week. Two of the minor reasons are because credit card debt just went over 1 trillion, which is crazy, and the 30-year mortgage is almost at 8%, which is just like, why would the mortgage ever be that high? And nobody's moving. So that's obviously going to make the home builder stocks and the whole stock market go down. So, yeah. But the market's down, and that means there's deals out there, and you need to take advantage of those deals and keep learning stuff about the stock market and learn how to value companies. Because I can tell you there's a lot of undervalued companies out there right now. So scoop them up and make some cash flow. And I'll see you next time. Have a good day.